Hello and welcome to today's video where we talk about a particular type of mortgage only available for physicians and dentists. It's called the doctor loan and we're going to talk about it right now. Let's get started. So I know most of my videos are hopefully for everybody who's listening, but today we are going to talk about something that isn't relevant to everybody. See, the physician loan is a mortgage that is only available to physicians and dentists. So we're going to get a little more narrow in this video, but hopefully it's helpful to some of you out there. If you are a physician or a dentist, you know that there are some things that can make it really difficult to accomplish when you're trying to buy a home. You have really high student loan balances. Maybe you are in and out of training and you don't know whether you're going to be moving in 3 years or 5 years, whether this is the dream home, whether it's a starter home, your student loan payment's really high. Whatever the reason is, there are some things that make it a little more difficult than you would expect for someone who has your income. And for you, there is the physician loan. To go through the details of why this is an important and really a pretty cool offering, we have to go back through some of the old terms that we've covered in the past related to home buying. So the first thing that you have to know is when you get into a house, there are two things that you have to pay before you get into that house. The first is a down payment. So how much of that home's value are you bringing to the table as a down payment? And also closing costs. Closing costs are the cost of wrapping up the loan buying process. And that could be anything from 1 to 2% of the value of that mortgage in terms of closing costs. And when you have a down payment, your lender oftentimes under a conventional loan wants you to bring at least 20% of that home value to the table. That's really important to a physician or dentist because while you are in training, it would be really hard to find a way to save up 20% of the value of the home that you are trying to purchase. It's even hard to come up with those closing costs sometimes. Now, if you can't come up with those items, that 20% down payment, then your lender under a conventional loan is going to consider you a risky borrower. And in that case, they are going to likely put something called PMI on your mortgage. We covered that in our last video. PMI is private mortgage insurance. It is an extra insurance on top of your loan payment that compensates your lender in the case that you default on your loan, but you have to pay for it. So PMI can range from anywhere from 0.5% to 1.5% of the value of that mortgage, and that can really add up. Another thing that doesn't help when it comes to PMI for a physician or a dentist is some people make enough adjusted gross income or below a certain amount, I should say, that they can actually claim PMI on their taxes. It is a tax deduction for them. But unfortunately, unless you are really in the middle of your training as a healthcare professional, it is highly likely that you earn too much to claim that as a deduction on your taxes, so it doesn't benefit you. So when you're looking at trying to buy a house under a conventional loan as a physician or dentist, it's really hard to come up with the down payment of 20%. It's hard to come up with the closing costs, and it also puts you at risk of having PMI on your mortgage and not even being able to deduct it on your home loan. Not ideal. But there's one more area that makes it even tougher for you to qualify if you are a physician or dentist with high student loans, and that's your debt to income ratio. If you recall, debt to income ratio is an expression of how much of your monthly income is swallowed up by your debt payments. So for example, if you have a $10,000 monthly income and your debt payments are $3,000 a month, then you have a debt to income ratio of 30%. Now, if you're talking to a lender, they may say that they want your debt to income ratio to be in the high 30s to low 40s potentially to consider yourself as a good risk for that lender. They do believe that you will be able to make those payments and not default on your home loan. But here's the problem related to student loans. Many of you who have high federal loan balances are on an income-driven plan, and those plans do not ask you to pay based on an amount that would be needed to pay your loan off in full, which could be multiple thousands a month. They ask you to pay based on a percentage of your discretionary income. So you might be paying a few $100s a month or $1,000 a month, but far less than would be needed to actually pay the loan off in full. Unfortunately, with a conventional loan, many lenders do not allow you to use that income-driven payment when they calculate your debt-to-income ratio. Instead, they're going to look at how long you have to pay that payment, so 20 or 25 years, and they're going to calculate for themselves what that payment would be to actually finish paying the loans, and that's what they use for your debt-to-income calculation. Unfortunately, when you do this, many physicians and dentists are knocked out of the debt-to-income requirements that are needed for a conventional loan, and their lender sees them as too much of a risk to offer that home loan. So, how does the physician loan differ from the conventional loan buying process, and what are some things that you could do to put yourself in a position to take advantage of it? We'll cover that now. Let's go back to the first two areas of home buying that we talked about: down payment and closing costs. So unlike in a conventional loan, when you talk about a down payment, where in a conventional loan they want you to come up with 20%, otherwise you might have private mortgage insurance tacked onto your payment, under a physician loan they will let you have a payment as low as 0% to 5%, all without having PMI on your home loan. Now, it's important to know that your lender is not that generous. In exchange for them not giving you PMI on a low down payment, they oftentimes have a higher interest rate on a physician loan than you would find on a conventional loan. That doesn't concern me. You have to decide for yourself if it concerns you. But the reason it doesn't concern me is if you're a high income earner, as we just covered, it is highly unlikely that you can deduct a portion of your PMI payment on your taxes each year. But it's actually a much higher threshold for if you can deduct your mortgage interest that you pay on your home loan. So while you do have a higher interest rate, you also give yourself a better opportunity to have a tax deduction with a physician loan than you would by doing a conventional loan with private mortgage insurance. The second area, closing costs, actually operates the same way as you would find under a conventional loan. It's the same percentage, and you will typically find under a physician loan the closing costs are a bit higher, and here's why. Closing costs are calculated off of the balance of the mortgage. So if you're in a physician loan and you have no down payment at all or a small down payment, they're calculating those closing costs on a higher number, thus you have higher closing costs. So those are the first two areas and how they differ or are slightly similar to the conventional loan buying process. Now, the last area we talked about was the debt to income ratio. Here's how that differs with a physician loan. With a regular loan, again, they do not allow you to use the income-driven plans, many lenders that is, when they're calculating your debt to income ratio. They use the amount that would be needed to pay that loan off in full. Fortunately, when you have a physician loan, they do let you use the amount you're using for an income-driven payment, and that gives you a much better opportunity to either qualify, period, or to be looked at as a more responsible bet for that lender, and thus you might get a lower interest rate or more favorable terms than you would trying to get a conventional loan for your home. Let's look at a couple examples of what that might look like for your home buying process. Let's say a couple with one physician in the home has an adjusted gross income of $250,000 and wants to buy a $300,000 home. Now, if their lender requires a 20% down payment to avoid PMI, they would need to put down $60,000. And if they don't have that, they will not only have PMI, but they likely won't be able to deduct it because they make too much money, so it doesn't help them on their taxes. They'll also have to pay closing costs. So let's say that they do pay the $60,000 and that leaves them with a mortgage of $240,000. And if the closing costs are 2% of the mortgage amount, that would mean $4,800 in closing costs. This would mean the couple has to pay $64,800 to get into their home with a conventional mortgage. And that's if they even qualify with the calculation for the debt to income ratio. Conversely, let's say that the same lender has a physician loan that requires no down payment, only closing costs. For the same $300,000 home, they would pay nothing for a down payment and still avoid PMI. Now, this would also mean that the mortgage amount is the full $300,000. And since closing costs are calculated based on the mortgage, that 2% would mean that their closing costs are higher. They would be $6,000. But instead of the $64,800 it took under a conventional mortgage, this couple gets into that same house using a physician loan for $6,000. That's it. I hope this video was a little useful to you and maybe broke down a little bit about how the physician loan works if you find yourself in that situation. If you like what you heard, please share what you heard. We want to share it with as many people as we possibly can because we want to help as many people as we possibly can. And if you have a topic you want to hear about in future videos, you can submit those by going to my website, www.brensonharrison.com. And under the blog section, there's a questionnaire you can fill out for topics you want to hear in the future. I'll see you guys next time.